President Trump is pushing an agenda focused on affordability, unveiling several proposals since the start of the year that are aimed at addressing rising costs. The proposals including a 10% cap on credit card rates, a ban on large investors buying single-family homes, and an order for government-backed mortgage finance companies Fannie Mae and Freddie Mac to buy $200 billion worth of mortgage bonds. The president most recently also focusing on the cost of electricity, saying that Microsoft will be making changes to ensure Americans don't pay higher utility bills for power consumption from the AI data center build out. Still with me to talk about these affordability issues, Jennifer Lee, BMO Capital Markets Senior Economist and Managing Director, and Claudia Sahm, New Century Advisors Chief Economist and former Federal Reserve Board Economist. And I believe also Microsoft is out with some of its plans over the build out of its data centers. But I'm curious, Jen, as you look at these various measures, proposals that the president has talked about, how far do you think they go at sort of solving or helping solve some of these affordability issues?
Oh, that's a tough question. Oh boy, the reaction, of course, I'm sure all the CEOs were very, polite in their answers and said, yes, we will try, and I'm sure there will be an effort to comply. But there's only so much that these corporations can do. I mean, people have to make money, right? The companies have to have to boost earnings or make earnings, and if they're swallowing all the costs, they already did it for some of the tariffs, and if now they're being asked to do so in terms of their electricity usage and all that, it's going to be tough. So at first glance, obviously, it suggests that we will see some lower pressures, I guess, on inflation. But again, as Claudia was mentioning earlier, longer term, I don't know how much lasting power this is going to have. And I think that's the big question, is that whether or not they can actually afford to be able to do so going forward in the longer term.
I mean, by the same token, Claudia, if you look at the estimates for corporate profits this year, they're expected to still go up, and particularly for the tech firms. So I guess there's the question of, can they afford it? And there's also the question of whether how much and whether this will move the needle.
Right. Yeah. So affordability is a real issue. I mean, and it's not just like a political slogan. It is affecting people's lives, and prices have gone up. And so efforts to make the basics more affordable make a lot of sense. What I worry about is, we're starting a midterm election year. It's clear the president is very focused on re-election. And politicians, that's what they do, right? Like this, it makes sense that we're seeing this. I am concerned about this continued flood the zone approach to economic policy, right? You put out all of these different ideas, and in particular things like announcing a 1-year 10% cap on credit card rates, just kind of out of the blue, and kind of pushing like this is going to happen by next week. I think that's not how economic policy gets done. So we're in, like, this is, if you had a good policy and you pushed it through and it actually meant something to people in the end, that would be great. But this has a lot of, there's a lot of spectacle to this, and I'm really concerned about whether this ends up meaning anything to people.
Claudia, what would be a more holistic approach to all of this, just briefly?
Well, I think one thing that concerns me, like with the credit card cap, which, even if one thought that were a good economic policy, and there have been proposals put out from different senators and whatever, I'm not in favor of a cap, but you wouldn't propose it for 1 year, right? Like that is such a political move for 1 year, because that could actually get people in an even worse position if they took on more debt because rates were lower. So I guess just really backing up, slowing down the process, focusing on like really moving the needle, which is going to take time. It's going to take more time than the clock has left for the midterms, frankly.
Yes, well, the vagaries of politics make certain this is our system. I guess, Jennifer, Claudia, we're going to leave it there for now. I'm sure we'll continue the conversation next time. Thank you.
President Trump's cap on credit card rates. We heard from Citi, Bank of America, JP Morgan executives making it clear they have some questions and concerns about that idea. I am curious, as an analyst who covers this space, how are you thinking through it?
I think all the banks were careful to not just throw it away is rhetoric. I mean, I think that they recognized that if it came to pass, it would be a big hit to their earnings. But I think also they recognize, and most do in the investment community, if it did come to pass, that it would really limit credit to a lot of consumers. One of the reasons why those rates are where they are is simply to compensate for the risk that these institutions are taking. So, I mean, if you had a credit cap, I think you'd find a lot of consumers pushed out of the card market and probably go to places where there are higher rates like payday loans. So I'm not so sure it would necessarily be good policy. Not so sure necessarily the president could do it either. It probably needs an act of Congress. But if it did come to pass, it would be a negative from an earnings standpoint. And I think a lot of the banks here who have already reported, we're trying to meet it and saying, look, we are focused on affordability. We're trying to serve our customer base. This is something we're really conscious of. But it would be a negative if it came to pass. But I would put not a lot of stock into it and that the Congress would take hold of this.
Nathan, so good to have you on the show today. Thank you, sir.
Thank you.
A new call from President Trump for credit card issuers to cap the interest rates they charge at 10%. Here with more on what to watch as the banks report, Gerard Cassidy, RBC Capital Markets analyst. And, you know, Gerard, I was planning on having just a straightforward earnings prediction conversation. Then we had a little bit of a wrench thrown into the works, as we have had a lot recently. And so I have to ask you first about this proposed 10% cap on interest rates charged on credit cards. It's unclear how and whether it's going to go into effect, but how are you thinking about what effect it could have on these companies?
Thank you. And you're right. We were hoping to have a more focused conversation about what the fourth quarter earnings, but this news certainly takes priority. And at this point, it's going to be very interesting because it's our understanding, obviously, through an executive order, the credit card companies are not going to be required to lower their credit card rates to 10%. It either has to come through legislation in Congress or codified through the regulators, similar to the Credit Card Act of 2009 that came through Congress. And so it is certainly weighing on the stocks today. Clearly, this president understands we're obviously have midterm elections. And as we saw with the election of the mayor in New York City, costs of living is a real talking point for the Democrats. And so if this is a way for the president to try to bring down, the costs for consumers, it's a political strategy on their part. But it would have real negative repercussions for many borrowers, because if the banks were actually forced to lower their credit card rates to 10%, certain borrowers would not qualify for credit cards and would affect the economy and affect it, of course, negatively. So right now it's in the early innings, of course. We're not, and as the stocks are now starting to recover a bit from the early sell-off, we do not expect this to go through, and we do not, it'll be political fodder for probably the next couple of months, but we don't expect anything to really come from this where the banks are actually forced to lower rates to 10%.
And Gerard, just to be clear here about why you think it would be bad for borrowers, I mean, basically, would you expect, if this happened, would you expect the banks to basically say, to limit the number of people who they would approve for credit cards if they can't recoup the cost of that risk through charging a higher rate?
You put your finger right on it correctly. And so you look at some of these card companies that have 5, 6, 7% credit losses. And if you lower the credit card rate to 10%, how are they won't make money. The cost of running their operations is greater than 3% of total of that yield. And if you've got losses, again, of 5, 6, 7%, you're barely going to break even and probably lose money in some cases. So why lend? And so there would be a real dialing back to the higher risk borrowers, who tend to be the borrowers on credit cards that revolve and use those revolving natures of those cards to get them through maybe more difficult times. So it would shrink the amount of growth in consumer spending, likely, because there'd be less originations of credit cards.
Is this credit card thing going to happen?
No, definitely not.
Why not?
Because Congress would have to pass legislation, and you would see a battle on Capitol Hill, the like of which we haven't seen in a generation from the banks. Jamie Dimon would lead the charge. So I think that, the president is speaking in an aspirational sense.
But when the banks come and say, well, this would be terrible for U.S. consumers because we wouldn't issue them credit cards anymore, could the banks afford to still be relatively loose with credit In other words, could they take off 5% of the people they lend to and still cap it at 10%?
No, the business doesn't work that way. You would have to have a portfolio that was so pedestrian and with such low loss rates that they wouldn't do it. Let me give you an example. Probably the riskiest credit card issuer in the country is Synchrony. Synchrony wrote off 5% of loans and total loans last quarter. That's normal for their business because they have a 20% average spread.
Right.
Their highest is probably close to 30. So all of these credit card businesses subsidize the bad loans with the good loans.
Right.
It's just the way it works.
Yeah.
We can just say, okay, nobody has credit anymore, or force people to come in and get unsecured credit lines individual by individual.
Right.
But even then, the banks, let's put it this way, the banks have been a little piggy when it comes to yields. They have been, because the rest of the book doesn't make a lot of money. This is why they don't own single-family mortgages. The returns on single-family mortgages are awful.
Yeah.
But on the other hand, credit cards and then loans to non-bank financial institutions, those are the two areas of growth for banks this year.
And the latter one is where you think there might be some trouble.
Oh God!
Okay, so talk to me. So talk to me about that. So you said earlier that you're watching private equity and the loans to these non-bank institutions, like private equity and private credit firms.
Correct.
Very closely. Now, there's been a lot of words that were thrown around in 2025 about this stuff. Cockroaches was Jamie Dimon's word. Idiosyncratic was the word that everybody else seemed to be using.
Yeah, war frats.
That these aren't things that are very common.
Private equity is a world that is often misunderstood. It's mostly funded with debt rather than equity. And there are probably 15 to 20% of all private equity companies in the United States today that are essentially in default, but they're still paying by giving investors more equity. So this has the pernicious effect of causing the book value of these things to rise, even though the entity is essentially in default. The whole industry is whistling past the graveyard, and the banks have been lending to the private equity managers on a non-recourse basis. I think when some of these banks have to fess up and really talk about the actual credit quality of these portfolios, they're going to end up getting sued.
But as long as the economic cycle does not turn dramatically, can they keep going?
No, this is disconnected from the economy.
Okay.
This is a function of private equity firms that went out and bought everything and anything they could find because they earn fees. And then they can't turn around and sell the company. I'll give you a great example. J.D. Power and Associates was taken private by private. They can't sell it. It's unsaleable. And the canary in the coal mine here is the BDCs. If you look at business development companies that have to report under GAAP, what you see is that they are showing you a large number of their portfolio companies are doing what we call PIK, pay in kind instead of in cash.
So how is that going to play out this year? And will it happen this year?
It will play out in an idiosyncratic fashion every time one of these gets to the point where the sponsors can't wait anymore and the investors can't wait anymore, then they'll put it into bankruptcy and they'll realize the loss. The redemptions coming out of some of these private credit funds are astronomical. And yet, ironically, they're still raising new money.
I can't explain Wall Street sometimes.
No, the banks are always behind the curtain. You're never going to really understand what they're doing unless you dig into a lot of non-GAAP sources, talk to people in the industry, and that's where you start to understand what's going on.
And that's where you come in. So we're glad that you're here. Thanks,
My
Chris.
pleasure, Julie.
Appreciate it.
Trump wants a one-year cap on credit card interest rates of 10% starting on January 20th. JP Morgan warning it would significantly change the credit card business. Here to sort out what those changes may look like, let's welcome in now Bankrate senior industry analyst. That would be Ted Rossman. Ted, it is great to see you. Maybe start here. Can you just walk us through the math, Ted? The average card holder, I'll let you pick out the balance and interest. How much could folks actually save if this went through? Can we put some numbers on this?
In theory, people could save a lot of money. The average credit card debt load is about $6,500, according to TransUnion. And the average interest rate's around 20%. So if you make minimum payments towards $6,500 at 20%, you're in debt for 18 years and you end up paying more than $9,000 in interest. This 10% cap would definitely help. Now, it would be only 1 year, and it's apparently something that would need congressional approval. It can't be done by executive order. So there's a lot of asterisks attached to this. The financial industry also says that they would have to cut way back on access to credit if this kind of thing were to pass. So there's a lot of unintended consequences. I actually think a better approach would be to take matters into your own hands, get a 0% balance transfer card, and try to pay the debt off that way.
You mentioned an important point there, Ted, and I just want to circle back on it, because that is an argument someone brought up, and you know this, against this. If you have a rate cap like this, so the argument goes, what you're going to really do is restrict access to credit, and I'm curious to get your take on that. One, do you agree with that? And two, if you do, who would feel the brunt of that immediately?
Yes, that's something I've been hearing across the industry, something that would most squarely impact people with lower incomes and lower credit scores. Because credit cards are really all about risk management. It's a pretty amazing loan if you think about it. It's this open-ended credit limit that you can use pretty much anywhere, anytime, on anything. Lenders have to price for risk. It's unsecured debt. There's no home or car on the line as collateral. They worry people aren't going to pay them back. And right now, about 3% of credit card balances are delinquent. Another 4% are in charge-off status. So basically 7% are either late or in default. That's their big worry. So I've seen estimates like the Electronic Payments Coalition did a study with the Missouri Bankers Association. They said somewhere between 82 and 88% of credit card holders could lose some or all access to credit if this kind of thing were to pass. 10% is a really low cap. The average is 20. Many people are paying 25, 30, even more. I mean, to find a credit card under 10%, that's a very niche option offered by a handful of credit unions to people with really good credit.
The other thing, Ted, is, if this happens, banks don't make as much on interest. They're going to try to make that back. And I'm curious how you think they may try to do that. Would it be higher fees, fewer rewards? What do you think?
This would really revolutionize the credit card industry, and not in a good way, I would say. I know we don't want you paying these high interest rates, but like I said, you can pay in full, you can get a 0% balance transfer, you can follow some other payoff strategies, work with a reputable nonprofit credit counselor. I just think the cutbacks would be so severe that if that many people are losing access to credit, well, then what? People need credit for groceries and car repairs, and we don't want long-term debt, but we also don't want you turning to a 400% payday loan. So I feel like there does need to be a trade-off here, and credit does fill a useful role in the ecosystem. So if this kind of thing were to pass, I don't think it will, but if it passes, I just think that there would be huge cutbacks in access to credit. Rewards would probably be decimated as well. Other fees would probably go up. Maybe these big banks who are making less on credit cards would charge more for auto loans, mortgages, bank accounts. I really feel like the effects would be widespread.
Let's say, Ted, I'm a viewer, I'm watching this. I am dealing with, relatively high interest rates. Any advice, Ted, tips and tricks, what I should do here? Should I sit tight and wait to see, hey, how this all shakes out?
I would say take matters into your own hands. Make your personal credit card rate 0. You can pay in full. I know it's easier said than done, but half of cardholders already do that. If you can't pay in full, there are 0% balance transfer cards available for up to 24 months. You could get a card like the US Bank Shield Visa. 2 years interest free is amazing. Like back to that $6,500 average debt load example, you could pay less than $300 a month for 2 years and be debt free, interest free. There's no free lunch. I mean, these cards do have interest rates that go way up after the 0% term ends, but use that time to your advantage, or work with a reputable nonprofit like Money Management International who can bring your rate down to 7% over the next 4 or 5 years and really attack your debt that way. I just think the price control approach would have a real negative set of unintended consequences and would also set a bad precedent for other industries. Price controls don't feel like the way to go.
Ted, so good to have you on the show today. Thanks so much for your time.
Of course, thank you.
Joining me now, Sebastian Siemiatkowski, Klarna co-founder and CEO. Sebastian, it's good to see you.
Good to see you.
It seems like this credit card thing is not going to happen at this point. It also seems like if it did happen, it could be good for Klarna. So given that it's probably not happening, kind of how are you thinking about it at this point? And it seems like it's been kind of a good marketing point for you guys this week.
Well, maybe I'm the only CEO of a bank that actually dares to talk about this topic because, we are one or maybe the only bank in the world who hasn't built our whole profit on the idea of putting people in, making them revolve up to $5,000. Our average balance is $100, and not having them pay, 30% on revolving. That in the US in total generates $30 billion of revenue per year. So obviously this, in my opinion, very thoughtful and good suggestion from Trump to cut it to 10% would have returned maybe 20 billion of that back to US consumers. And it's not uncommon. We've seen interest rate regulation in Europe work pretty well.
There is one of your competitors, sort of a fintech startup called Gilt, that's now said they're going to come out with a credit card that has a 10% cap on interest rates. Would you guys be willing to do the same? Ours are 0% if you look at the buy now, pay later product. And I think in general, the thing is that I'm saying a credit card specifically.
Yeah. No, we have a credit card as well that offers you to put on installments, single transactions at 0%. So you could do that. But I think, again, it comes back to, so the answer is yes.
The answer is yes. You guys would come out with a credit card at 10%.
Well, we would definitely consider it. I think, again, the question is how do you construct a product that is healthier than the existing credit products? And one is to avoid revolving. And another one is to not try to make money by pushing people into debt and maximizing on the interest rate. So you have to find other ways of making money, or you just accept a slightly lower return on investment, which is what Klarna has done. In one way you could call us a more affordable bank, means we accept slightly lower profitability. But what's interesting is when you do that, you get the self-aware avoiders, customers who actually have learned themselves the hard way that credit cards do pushes them into debt and are looking for alternatives. And those are very economically savvy and interested customers. And hence our losses are 30 bips lower than industry standards, or about 30% lower than industry standards. So because that audience is also more careful about their spending habits and you don't make them max out. If you do make people max out, you're going to see higher losses.
By the same token, I've seen study numbers that say that using buy now, pay later does encourage people to spend more than they otherwise would, either buying more stuff or spending more on particular items. I guess what I'm saying is, what did they say about glass houses? There's criticism of buy now, pay later and how it potentially promotes irresponsible spending as well. So how would you respond to that?
Well, first, it's very important to know that the most money you can make in the world as from marketing is to sell credit card ads and financial services ads, because these guys are willing to pay a lot. And so we have a very strange society where a lot of people are making a lot of money from promoting cards. And that in itself then may lead them to write more positively about credit cards as a product. There's also a lot of lobbying going on because there are tremendous profits at risk here. But the truth is that, and as I always say, look, I'm still offering people a form of credit. Credit can always and will always have the downside of occasionally leading people to overextending themselves and so forth. But what you have to ask yourself, is it a better form of credit than the traditional form of credit? And I would argue, everything else equal, if you either have a person using a credit card, putting all of their spending every month on that credit card and then revolving, leading to about $5,000 in average balance and 30% interest on that, as compared to using primarily debit, then occasionally using buy now, pay later with a fixed installment and a 0% interest, that is, with an average outstanding balance with us, which is about $100, that is a better outcome for society and for consumers at large. But I'm still fighting fire with fire, which is pretty effective. So I'm not selling debit cards only, right? We do offer debit cards as well, but we are offering credit. So obviously, there's always going to be issues with credit. And what we have to do is make sure that we offer this responsibly, following all the regulatory requirements, but also being thoughtful about how we promote and suggest the usage of our products to the consumers.
Sebastian, I'm curious about something. There's been a lot of fintech innovation over the past decade. You guys are part of that. You got blockchain, you got all stablecoins, all kinds of stuff happening. Fast forward 5-10 years from now, what do you think the financial landscape looks like? How do most people bank? How do most people pay, do you think?
Well, yeah. I mean, we thought about that in 2015 when we pivoted in this direction. We sat down, we asked ourselves, where is the future going? And our conclusion was the future of financial services is going to be a digital financial assistant that looks at your spending, look at your day-to-day transactions, but also your mortgages and your insurances and all that. And basically, over analyzing it overnight, wakes you up in the morning and say, hey, I looked at your mortgage, you're overspending, I could save you $20, and I've done all the paperwork and negotiated a new one for you, so the only thing you need to do is say yes. At that point of time, will you care that mortgage was with Wells Fargo or somebody else? You won't. You'll be like, thank you, assistant, thank you for $20, I'm happy to take it. Can you fix my home insurance as well? So we concluded that that's the direction in which financial services is going. Now, this is like self-driving cars. I can't tell you when it will happen. I can only tell you that I'm very certain it will happen. And what it means that the excess profits that we have seen among retail banks are gonna go away. Because the excess profits that exist in retail banking today come from the fact that switching cost is high, come from the fact that we as consumers find these products complex, boring, don't put enough energy on researching and comparing alternatives, and it's hard to do so. With the help of AI, we will be supported in doing that, and that will drive down excess profits. And with the help of AI, it will be easier to switch bank accounts.
Sebastian,
you will ask your AI assistant to switch it for you. So it is the end of excess profits in banking that we're seeing, and fintech will contribute to that.
I mean, looking at the bank earnings we've gotten so far this week, it looks like we're still pretty far, though, from... I did say 5 to 10 years, to be fair. But those profits are still alive and well.
That's very true. And that's, it's always like, it's always a question of, again, to your point, some people believe this is going to happen earlier. Some people would say it's going to take a longer time. I've been doing this for 20 years. To me, it's very clear that whoever dares to be the bank, just like Walmart was, just like IKEA was, these large companies that recognize that when they became bigger, when they reached scale, they took some of that profit and lowered their price and make themselves more affordable. Whoever is willing to be that driving force in banking is the long-term winner. And that's what we're trying to be with Klarna. And over time, you'll have to sacrifice a little bit of profit, short-term profit for that, but you're going to build trust and the benefit of an audience that actually sees that you. And then I don't know when did you last time hear one of those banks now, as they report these amazing profits, say, and as a consequence of this amazing quarter, we're giving this back in lower interest rates to our customers. Like I don't hear them say that. It's not happening.
You don't hear too many public companies generally saying that, not just in banking, but
True.
Yeah. All right, Sebastian, we got to leave it there, but we will talk again soon, I'm quite sure. Thank you.
Thank you, Julie.